ESG risk disclosure phrasing, write investor-ready reports. Welcome. In ESG reporting, investors price risk, not warm promises. They ask, what could go wrong? How big could it be? And what are you doing about it? Clear, straight-to-the-point phrasing builds trust fast because it reduces guesswork and legal ambiguity. Ditch marketing fluff and focus on material issues, the ones that can hit revenue, raise costs, or restrict access to capital. For example, a carbon-intensive supplier base is material. Office recycling stats probably aren't. Your goal: show how ESG factors translate into financial exposure and management actions. That's how you move from storytelling to decision-useful disclosure. Start with sector-specific, high-impact risks. A bank faces credit and transition risk. A miner faces safety, water, and community license risks. Don't list everything. Prioritize the few that could move your financials. For each risk, clearly tie it to revenue, cost, or capital access. Example: drought may curtail plant output, reducing revenue by X%. Use recognized frameworks: SASB for industry topics, TCFD for climate risk and governance, and CSRD for European double materiality and required disclosures. Mapping to these standards signals rigor and comparability, helping investors quickly benchmark you against peers. Use a simple structure. If X risk occurs, Y financial effect may result. Example: if carbon prices exceed $80 per ton, operating costs may rise 3 to 5%. Then add likelihood and time horizon. Near term, 0 to 3 years, medium, 3 to 10, long, greater than 10, with a probability band if available. Finally, name affected assets, operations, or markets, so exposure is concrete. Scope: EU plants A and B, product line C, market share in Germany. This format turns vague concerns into decision-useful information that can be modeled, stress-tested, and compared across companies. Skip words like robust, world-class, or leading. Replace them with data, thresholds, and audits. For instance, supplier compliance rate 92%, threshold 95%, audited by third party in 2024. Cite metrics, baselines, and year-over-year change. Water intensity 2.1 m³/unit versus 2.4 last year, minus 12%. Where possible, reference external assurance or certifications. Limited assurance over GHG inventory. ISO 14001 at 3 sites. Numbers, methods, and independent checks build credibility and protect you from accusations of greenwashing or selective disclosure. Explain who owns each control and how often it runs. Control owner, e.g., head of operations. Cadence, monthly, quarterly. Describe the process, how you identify risks, screening, heat maps, monitor indicators, dashboards, alerts, and respond. Hedging, diversification, engineering changes. Be candid about gaps and residual risk after controls. What remains if a drought persists or prices spike? Then outline next steps with timelines and resources. This transparency shows management discipline and helps investors assess whether your mitigation matches the scale of the risk. Prioritize outcome metrics over activity counts. Injury rate reduced 20% beats 1,000 people trained. Define scope, boundary, and methodology so numbers are repeatable. Organizational scope, sites included, and methods, e.g., location-based versus market-based emissions. Then set targets with a clear level, timeline, and pathway. Net zero, Scope 1 and 2 by 2035. Interim -50% by 2030. Levers: efficiency, electrification, renewable PPAs. Link each KPI to the risk and financial impact it influences. Outcome-focused, well-scoped metrics let investors model progress, not just intentions. Avoid guarantees. Use calibrated verbs like aim, expect, seek, and may. This signals ambition without overpromising. Disclose assumptions and key dependencies. Policy stability, technology costs, supplier performance, customer demand. Note uncertainties and scenario limits. Model boundaries, data quality, climate scenarios used, and what they don't capture. Example: results are based on an $80–120 per ton carbon price range and assume grid decarbonization continues per national plans. Balanced language reduces legal risk and helps investors judge the plausibility of your trajectory. Lead with a concise summary that highlights key risks, strategy, metrics, and outlook. Follow with detail and appendices, methodologies, boundaries, controls, and data tables. Keep terms consistent, add cross-references, and use tags aligned to SASB, TCFD, and CSRD topics for easy navigation. Close with a section on key risks, KPIs, and outlook. What changed this year? What improved? What slipped? And what to watch next? This structure lets busy analysts grasp the headline story fast, then drill into evidence without hunting through marketing copy.